So actually, I do a podcast also for called the Digital Insurance Leaders Series, and same thing. When I first started, I had a few go to 50, 55 minutes, and eventually now I've done 30 or so. Here's the big problem in insurance and in flood insurance, that there are, follow me here, there are 120 million homes in the US. 60 million of them are at moderate to extreme risk of flooding. So 60 million homes at moderate to extreme risk of flooding. Only 5.5 million have flood insurance. And most of those are with the National Flood Insurance Program, a government-run program. So 90% of the people that are at risk don't have any insurance at all. The model is to use multiple paper or multiple buckets of capacity. So we're on XL with Swiss Re behind it, and that's our largest program. We also have programs with RenRe and with two other Lloyd's entities, and then we've got a fifth program as well. So it's spread across A-rated paper, so very safe. But we're able to distribute the risk across multiple buckets of capacity. And what that means is if you're an MGA or a carrier with just one bucket of capacity, then you're going to run out of capacity very quickly if you sell a bunch of policies in Miami-Dade County, for example, or Orange County in LA. So the National Flood Insurance Program started in 1968, and for really through maybe 2010, it was the only game in town. So when you think about flood insurance, and the people listening to your podcast will probably either already know this or will get it immediately, but it was what I'd refer to as an unmodelable risk. When let's say hurricanes, when hurricanes occurred, do you know where it's going to hit? No. We have no idea where they're going to hit this year. Gulf Coast, probably, but would it be Mobile, or would it be New Orleans again, or would it be Houston, or will it be Tampa, where I am? You don't know. The use of AI, particularly in the aggregation model. So traditionally in insurance, the biggest problem in insurance is actually not getting your pricing right. It's actually over aggregating. In other words, selling too many policies in a small geographic area. Then an event occurs, you have too high loss, and it actually jeopardizes the business and it jeopardizes your policyholders. So it's a direct contractual relationship with they are independent agents, as you said, but then some are big carriers like Liberty Mutual or Hippo. Hippo's a great business partner of ours. And then, so there are carriers, there are MGAs that distribute our product, there are just retail agencies, and then there's the direct-to-consumer channel. So you get 4 tiers on how you can get to Neptune. What is unique about flood insurance is that 90% of the policies in the market are provided by the federal government. So that to me is a problem. That program loses $36 billion in debt, and will likely go into debt again this year if it's a heavy storm season. But the private markets are willing to take that up, and private markets actually offer better options for consumers. 2/3 of the time, we're lower priced than the federal program. We offer higher limits. We offer optional coverages like replacement cost and temporary living expense and things that you really need, not just want, but really need. Nobody wants to replace their 7-year-old waterlogged couch with another 7-year-old couch. They want to go buy a new couch.